So tariffs in this case are basically what a government basically imposes a tax on any of the imports that come from a country. So in this case, the US basically imposed tariffs on basically the world effectively. So any goods that the US imports from the rest of the world will get taxed. This is effectively a tax on anything that US does, imports versus the rest of the world. So if the rest of the world trades to the rest of the world, it's not affected by this tariff. So I think we need to make sure that it's kind of very US-centric and US very specific. I think China is obviously the strongest one here and the strongest ability to push back, right? So we have a balance of two powers where one needs a lot of face, one keeps increasing, one wants the other one to bow down, right? The other one does not want to bow down because obviously being the Chinese, face is very important, right? We cannot be seen as bowing down. And if they falter, the rest of the other countries will falter too, right? Because when you have more tariffs, higher prices effectively lead to lower consumption. Lower consumption basically leads to lower economic activity. If you think about it based from that way, he wants to effectively make a deal. I think that's from my standpoint. So both of them want to make a deal, but it's who cave in first to make a deal. So I think that's the main point.
So what I'm hearing is they are not incentivized to crash the market, right? But you never know what will happen.
We never know what will
as
happen.
things spiral out, right? Welcome to an emergency episode of Chills with TFC. I'm your host, Reggie, aka your Chief Financial Coconut. And of course, it's an emergency because the market is going cray-cray, right? And before we could record, the market already go cray-cray the other side, right? So there is all these things that are happening. And I'm sure, you are a little bit concerned about like what's happening, why are these things doing, what's with this tariff, and then the market react this way. Is this an opportunity? I know there's a lot of questions. So this is our special segment called This Is Not Financial Advice, right? We will short form call it Tinfa, right? Going forward, if you ask any questions on Chills and we reply you, this segment will be Tinfa. Okay, so I am very glad to join my two emergency contacts. Only good friends of the show can come in a short period of time, right? So for our audience that somehow don't know you, I think Eugene, it's been a long time since you're here. Right, so maybe just give our audience an update, like for people that don't know you, who you are, and then for people that know you, like what are you doing now and all that good stuff.
Thanks a lot, Reggie, for inviting me on the show. My name is Eugene. I run Vision Capital Fund. It's a long-only global equity investment fund. We just started about 6 months ago. Previously, I've been an individual investor investing my own capital for close to over 7 years. So did quite well.
And
so
6 months in, this thing happened.
Yes. nice emergency coming into this.
Yeah. Okay, great. Hey, you want to share a little bit more? How was the investment thesis? How do you all do those things and all that?
Yeah. So I think what we do is that we try to find companies that are riding very long-term secular tailwinds. They are basically top dogs, and what we think that market structures tend to be kind of like monopolistic, oligopolistic in nature, which means these top dogs will tend to grow faster for longer and also make more money for longer. So as a nature, we're trying to look for multi-baggers. So ultimately, these multi-baggers, they got 5, 10, 15, 20, 50, 100 times, right? They will drive the majority of the portfolio returns and eventually lead to our performance. That's basically try to find the best companies in the world and own them for long periods of time.
Okay, so after doing shows for a long time, I've learned that the hook is at the end of the show, Eugene will share with you what is he looking at. What are his favorites, right? Okay, so you cannot share now, so you must stay to the end. Yes, and my favorite co-host today on the expert seat.
No, not here. They can say lah.
Yeah. For our audience, somehow don't know you. Maybe share.
Yeah, I mean,
what's going on?
I am much earlier than Eugene in the sense that I'm still a retail investor, right? Retailing my
The word is still, the keyword is still.
I don't think I would ever.
You don't think you ever? Okay.
I'd rather retire and relax, rather than take on the stress of other people's money. My own money is stress enough.
Fair. It's true.
Right?
It's true.
So I think, so I've always had interest in markets, interest in businesses, which is why I'm always here when CEOs come down, right? They can ask them about their business models. More than
that's a privilege, right? In some ways, right? You're so up close with them.
Go come chit chat with these people. So I mean, I'm very interested in my portfolio. A lot of skin in the game. I was going to ask questions, but now I'm going to answer them.
You're going to anscer them, right?
So it's okay. We'll figure it out.
Yes. So awesome. Maybe for a start, can help us understand what's happening, right? Like, I think there's a whole tariff part of the situation, which possibly is the trigger, and then there's the whole market reaction to it. So there are multiple layers to this. So before we go into your questions, let's kind of set the ground for our audience. Eugene, you want to take a jab at this?
Yep. I think let's try to go back to what tariffs are to start off first, right? Let's try to go back to kind of like international economics 101. So tariffs in this case are basically what a government basically imposes a tax on any of the imports that come from a country. So in this case, the US basically imposed tariffs on basically the world effectively. So any goods that the US imports from the rest of the world will get taxed. This is effectively a tax on anything that US does imports versus the rest of the world. So if the rest of the world trades to the rest of the world, it's not affected by this tariff. So I think we need to make sure that it's kind of very US-centric and US very specific. This is a trade tariff, which means it's really specific to goods, so it doesn't apply to services. So goods, again, US goods imports that are coming in. I think what happens is that you have seen in this case, the US has been running a very large current account deficit of about $1 trillion relative to the rest of the world. Right, I think you have Europe and China accounting for about close to 100% of that. Obviously, that's where the that's where the imbalances have been kind of building up over the last couple of decades, right? And I think on the US side, when Trump came in, he basically has a couple of things that he wants to look at, right? The first things first is that he has a very large current account deficit, so he wants to really reduce this. The second thing is that basically he has a large budget deficit. He wants to reduce the large budget deficit too, right? So he needs to go and do a lot of things. So by putting on tariffs, in a way, he can get some revenue from it, in a way reducing the budget deficit. Third thing is ultimately he wants to do is to kind of bring back selected, I would say, advanced manufacturing back to the US. I wouldn't say all, right? You don't want the US to start making t-shirts again.
Right? It's not going to be viable anyway.
Exactly,
right?
Correct. I think you want the US to be making the more important things, they're more strategic kind of like to them in overall the aspect. So I think by doing this, I think that's ultimately the main goal that what Trump has. But you try to go back to tariffs, right? And I think we need to kind of think about why do we trade internationally in the first place? When we trade internationally, it boils back down to comparative advantages. So if everyone tries to make whatever they need, globally as a whole in aggregate, they will actually have less. So international trade is a good thing. The problem happens is that when kind of it's unbalanced, I think now brings us back to this point. We have basically from international trade been trying to push tariffs down for a long period of time. But I think what happens is that if you look at it actually globally in the numbers, relative to the US, most of the other countries actually have higher tariff rates relative to the US. So the US has a much more lower relative rates. And I think that's where I guess the basis of Trump saying that, the rest of the world has been kind of being unfair against the US. And effectively what the US is trying to do is to, I think, globally lower tariffs as a whole, which is better for the world. And if the world has more international trade as a result, that could be. But can he obviously do that? Probably very difficult as well. And if he can get some tariff revenue as a result to lower his budget deficit, it's kind of like a win-win. So I think that's ultimately the end goal that we boil down to this very day.
So that is your read on the situation, right? Yeah. There are varying reads to this situation. Yeah. So you look like you have a different read of the situation.
I have a much different read.
Okay, awesome.
Right.
I love it.
My read is crazy people don't need analyze too much. Okay. Look, in the sense that I know it's very nice and it's very pretty to go, oh yeah, there's a big overarching plan, right? We want to do this, we want to achieve this. But I think, at least from what I've seen, my impression is that there is no overarching plan for him. It feels a bit more like the kind of, I wouldn't say bullying, more tyrannical, right? Where, okay, that's a worse word, but never mind.
It's fine.
Where you just use your power, you push as hard as you can, and then you see what sticks and what doesn't stick, right? And then you get concessions out of the way. So maybe that's a plan. Maybe the current account deficit is unfair, although I would say that really this whole new world order of pushing tariffs down is a US invention, right? So it's slightly hypocritical of US push it down and now US want to raise it again. And they have benefited, right? Because they have benefited from services, which is not goods and therefore not tariffs. And really the US is a service economy now that everybody is trying to get to, right? So I think that there's a bit of historical justification for why it's unfair. And to me, it has always been a trade-off, right? That the US buys, is the world's consumer, right? And in exchange, the US is the world's cultural leader, right? Is the hegemon, and that's kind of the trade-off. You want to be the big boss of everybody. You need to protect everybody. That's the reality of it. You shouldn't really try to have it both ways. But going to kind of what we are going to talk about, right? That kind of informs my slightly nihilistic view of the markets, that sometimes, you know what, there's a lot of narratives, a lot of stories. People will do what they want to do. Things will happen the way they want to happen. A lot of stock price movement is really quite Brownian motion, quite random. Even if longer term, which is where you'll come in, there are trends. So if you are just going to do short term, it's okay. No need to predict too much. No need to think too much. Just control yourself, know your plan, and stick to it.
Fair. Yeah. So you see, right? There are varying narratives. Even I think Prime Minister Lawrence have a very different narrative also, which comes back to the US versus China, who is trying to be the hegemon, the top dog, and then having a blanket tax across everybody is to kind of effect change in the supply chain and all that, so that essentially try to suppress China's rise, right? So, and it's becoming front and center in the Singapore narrative. I was quite shocked. You know what I mean? Like,
Lawrence came out. I was like, why did he come and talk about this? I don't understand.
Yeah. I was like, oh, okay. I thought this was a narrative that is, it's like there's a corner of the internet that talks about these things. And I'm
it's
sure
people like us that just look at the financial markets that keep talking about it.
Exactly. And for him to come out and say his position, it is a interesting phenomenon, right? But to conclude this part of the discussion, essentially you see that everybody has a different read on the situation. But truth of the matter is the US has decided to throw a blanket tax across everyone. And then there's all sorts of read around here, right? So that's that, right? But what is even more interesting that we then have to spend a lot of time to talk about is like, what the hell is happening in the markets, right? And the day of recording, I think there was a rebound. And, there's all these things that are happening. So maybe just kind of walk us through your read on like what's happening.
Yeah. So I think if you go back to the tariffs, right, I think when the US implements all these tariffs, the US could have just gone to China and just do a specific tariff negotiation, which I think they did during the previous Trump administration, right? But I think what Trump realized is that for me to negotiate down tariffs one by one of every single country, it would take them like forever. So effectively, they went on a very large scale, very draconian approach. So I think what happens is that you have more of the other countries coming back. I think about 75 countries are coming back to the US. They want to like reconcile. They want to negotiate back the tariffs, right? On the other hand, you see China basically, I think China is obviously the strongest one here and the strongest ability to push back, right? So the US started with a number, China's come here, and then now we suddenly up at 125,
the same
right?
game.
The same game,
just
right?
skip all the way to infinity.
Yeah,
I think we have a balance of two powers where both of them, one needs a lot of face. One keeps increasing. One wants the other one to bow down, right? The other one does not want to bow down because obviously being the Chinese, face is very important, right? We cannot be seen as bowing down. So we have a period where two guys are increasing power. Obviously these are the two biggest economies in the world, right? And if they falter, the rest of the other countries will falter too, right? Because when you have more tariffs, higher prices effectively lead to lower consumption. Lower consumption basically leads to lower economic activity, which means lower jobs, and so on and so forth, right? So you have a negative spiraling flywheel. So what happens is you've seen basically post the implement of the tariffs, markets have draconianly fell down. I mean, like the S&P went down like probably more than 20%, one of the biggest drawdowns you had, right? In the last 1 month or so, right? What happens is obviously you see overnight, Trump basically has said for all the countries that have came back, they will have a 90-day hiatus on all of those, but still have a minimum 10%, right? I think that's kind of like in line with what he still wants to extract some tariffs, but it's obviously not going to be needle moving from the standpoint. Obviously, with China is the only one that has pushed back. Now, markets obviously has seen this on very optimistically, and I think have retraced quite back significantly overnight. I'm not going to comment on very short-term moves. And I think that's ultimately, I don't think it's dissipating anytime. But I say, as investors, we have to be very fluid, right? It's very dynamic. It's a complex, adaptive game. Who knows, right? Trump and Xi might meet this month, and suddenly hammer a deal.
In Singapore, maybe in Singapore, yes.
In a neutral place, hammer a deal, and markets will be back to all-time highs, right? I mean, we don't know. They can obviously continue to escalate. That's going to be even worse for markets, right?
As much as we can't read the future, I think you can fathom a better guess, right? Like in that sense, there is some backdrop which is drawn back to the US-China competition, right? So you want to call it trade war, whatever, you can call it competition. The backdrop is there is a top dog that is losing out to the second dog. right? And then both sides are trying to jostle for the top dog. So they are actually all doing very rational, strategies on their part, or which can be perceived in all sorts of ways, but the baseline incentive is as such, right? And I think China has also shown that it has no interest in staying, where it is, right? Based on how they are stacking, right? So as much as we can quibble on the nitty-gritty, I think the baseline of what is happening is that there's a big boy that's getting challenged by the second, and then nobody wants to lose the top dog position, right? So that's a fair.
Yeah, I think this
right.
is an extension.
Yeah,
This is geopolitics, right?
Geopolitics.
It's not really like finance. It's really kind of the extension of the great power rivalry.
Yes.
Everybody has seen coming for 10 years.
Yes.
And maybe it's
unraveling and all that, right? So maybe what is your read on the? I know you look too tired to.
Yeah.
I was also a bit like, I was like, give me some time. I will start looking.
It's very good to work very hard, work very late, because I'm awake when the market opens, I'm awake when the market closes. US market. So it's fine. But I think my internal narrative of the story is the first few days of drop, right? So I think last Thursday, I think there was that first few big shocks because people perceive this as a change in the world order, right? Over the last, I would say, 80, 90 years since World War II, right? The world has really been on one trend, right? Globalization, lowering of tariffs, becoming more open, more trade. All of these are unequivocal goods, right? And I think we are kind of getting to that end of that phase now and it's a bit like internet, right? Where people are going, wait, we have all this open trade, we are accruing all these economic benefits, but is it really going to right people? Are there really no negative repercussions and all that? And maybe the story is that Trump has seen this is not the direction it should go into. We are spending a lot, so we need to accrue more benefits to ourselves and hold it back. And therefore, we need to change the world order, right? And him putting tariffs on 70, 80 countries, including countries with no people or like 1,000 people, it's really that signal that we are not here. We are not here just to keep China down. We are not here just to fight our enemies, essentially.
I want to be top dog.
Right?
Yeah.
I want to be top dog. All of you need to kind of pay something to me. So I'm going to tariff everybody. You are ally, you are enemy, do not care. I'm going to tariff all of you, right? And then the fear, and I think this was it is still a legitimate fear, it's not over, is that this is a change of the kind of globalization world order, right? Because it is actually a second or third step already.
In fact, I don't even think it's a fear. It's already unraveling in my point of view.
It's really a second or third step. This is not the first step,
exactly.
right? We have started moving away from China is China plus one and all these like whatever term that we are supposed to use that's politically correct, So we are moving further and further down this road, and the fear or the reality is that if we do go too much further down this road, then what happens, right? We don't know, because nobody has really seen this in the last 90, 100 years. Even if we look at financial data back to 150, the markets are so different, companies are so different. How do we ever judge, right? Everybody is kind of flying in the dark. So you don't really know what will happen. You de-risk lah, right? You just take money out, because you have made a lot of money over the last few years, and then we wait, right? We let the dust settle, we see what happens, and then we come back in.
Wait and see. Okay, great. So that's the backdrop. By the time this episode go out, we don't know. Maybe the market has just recovered already in a week's time. You don't know, and that's how crazy it is, right? So I think we can stop it at that point, and then we'll take some audience question, right? So once again, this is not financial advice, okay? This is our Tinfa segment. So thank you for putting in your questions. And in the future, if you have any specific questions, watch out for a call out. Put it there on our socials. We'll pick up your questions. So I have come to accept that a lot of our audience questions are very practical one, right? Which is great. So we start with the first one. By the name of Ru, 35. What does he do? What does he or she do for a living? I put notes on analyst reports, right? Okay, so maybe it's in the finance space in some shape or form. They have a question, right? The question very clear one. Will there be a recession? Whether there will be a recession. This, working professional concerned about this, right? So any read?
I think when you always see in financial media, people trying to predict recessions, and I think the number one thing that for sure is that whoever predicts recessions will consistently get it wrong. So I'm not going to predict a recession here. And I think trying to predict recessions here is a very futile attempt. It's just a fool's errand from the standpoint. I think trying to go back to it, right? It's like I mentioned, it is a complex adaptive game right now, right? If the trade wars between the US and China continue to persist, there will be further escalations, right? And we could go out into a trade war, right? And I think we just have to be fluid. But we know that Trump wants to negotiate. He wants to play the art of the deal, right? He wants to do something. And the Trump and CE, they are smart people. No one's going to crash the economy, right? Trump knows that Trump has 4 years, right? And after 4 years, Trump cannot get elected, right? So effectively, he needs to get support.
He has 2 years.
He has the midterms coming up.
The midterms coming up.
So he wants to leave a legacy, and I think he's not going to allow the markets to crash, right? So I think if you think about it, based from that way, he wants to effectively make a deal. I think that's from my standpoint. So both of them want to make a deal, but it's who cave in first to make a deal. So I think that's the main point.
So what I'm hearing is they are not incentivized to crash the market, right? But you never know what will happen.
We never know what will happen
as things spiral out, right? But actually, I want to take what you just said just now, Anthony, which is the risk-off mentality, right? So I think a lot of Singaporeans have been very aggressive. At least I think in our audience segment, people have been quite aggressive in the markets over the past decade or so and make good money, right? Yeah, being in the market, congratulations. That's why you can quibble about all these things, right? So many of them have made good money, and I think I wrote an opinion piece around this, right? On you can read on thefinancialcoconut.com, and essentially is to tell people to risk off, right? You can downsize your portfolio, hold more in cash, and then you wait and see, right? And also look at some of the baseline fundamentals that you would evaluate any investment, build a thesis, there's a price. If the price reverses to that price, your assumptions hold, then you can go in again, right? Because I do think a lot of professionals now, the fact that they're asking this question is built on this idea that, they are a bit stretched. You know what I mean? Like they have a thick mortgage, they have kids, and the job market is a bit of what is going on. So recession is not just it's not like will the market collapse, right? Like recession is a very specific term that suggests that you may lose your job, things will collapse and everything. So what I think is maybe you want to risk off, have some money on the side. If you have 3 properties, it's a good time to, maybe let some go.
I mean, with ABSD the way it is, you'll never rebuy that property.
Yeah.
So maybe not.
Yeah. So if you can kind of right size your portfolio, I think it's not a bad place to be, lah. Yeah. Any last things you want to add?
Yeah, I don't know about that, right? Because I mean, from my perspective, the goal is or always is, and everybody says this, it's long-term investing. Right? We consistently put money in the market to work because the belief, or at least in my view, the faith is that over the long run, markets go up, right? Due to economic growth, inflation, whatever, right? But don't know the reason, but markets go up. The line only goes right and up. So from that perspective, do we really want to sell, right? Because sure, you can. And I think that there's a lot of studies around, especially on retail investors' behavior on this, right? People sell at the wrong times, they buy at the wrong times, right? You would have sold 2 days ago after 3 full days of drops and it's 20% down, and then you missed that 10% pop yesterday. So, I think if you are financially stretched, right, you feel like you will lose your job, you feel like you really need cash, fine, sell, risk off, but if on the other side, it's like, it's uncertainty, but I should probably have a job. I have my savings, my emergency fund, I have my insurance. Then, do you really want to risk off? And because once you take it out, where are you going to put your money, right? I guess you could put in CPF, you could put in savings bonds, whatever, at 2.5% and barely I think you'll lose to inflation. So it's intrinsically already a losing move. Right? So I think not financial advice, clearly, but it's a very personal thing of your situation where do you think you need cash? Do you have cash on hand? If you don't have cash on hand, you might need cash because your job is already very unstable and you have survived 4 rounds of firings at a tech company, then fine, right? Sell RSUs, get cash out. But if you are very, very stable, you're a doctor in a public government hospital,
they forever need doctors.
Forever need doctor, forever a job. Like, why? Just keep buying, right?
No,
fair. This longer term, this would be one of the best times to buy.
Fair. I think that's a fair statement, right? So it's really about contextualizing back to where they are, right? So
Yes.
because I do think there's a big bunch of people that have stretched themselves, right? In this period.
If you're on margin, sell.
So this is not financial advice. I love the segment how it's called. This is not financial advice. So we don't need to keep saying this whole segment is this is not financial advice. Okay, so I think brings back down to your context. It is not about selling because the market is down, right? It's contextually, if you are in a stretch position, maybe you want to right size, because I do think the backdrop will continue. Whether how the markets will move, this one you cannot predict, but I think the competition backdrop will continue. I am of the view that it's not going to get more stable. It's just going to get, crazier, but how it moves is a different story. Okay, so that sums up the first part lah. I don't think anybody has a crystal ball, but they probably share a little bit of how you can think about this. Okay, so that's good. Hey, welcome to the Financial Coconut Podcast Network. I'm your host Reggie, aka your Chief Financial Coconut, and if you're loving what we're creating here, like, share, subscribe, share with your loved ones, comment in the comment section below, and we'll see you for great content on Chills with TFC. Second question, also a very pragmatic one from Ellie. She's 30, a manager. And her question is, how deep is the deep? When should we buy, right?
It's over. Back to business.
Budget Babe will say like, they should have done it last week, right? So, Any comments?
Okay, maybe I'll go first from like a
retail
investor,
how we look at it.
Psychology. So I think it started dipping Wednesday, Thursday. And then we have been very conditioned. I'm very conditioned. First big drop, buy. Right? Second big drop, the next day, oh shit, maybe not. Third continuous day, okay lah, I think I can buy a bit more lah. How far more can it go? And then I think I stopped buying for 1 or 2 days and then I bought again. So, besides saying, and of course, every time it's not all in lah, right? Because you can't all in. You keep layering in.
Yes, you layer in.
And I think that is kind of the way that I feel there should be dips, right? In the sense that, again, no crystal ball, never know what's going to happen next, never know the news that will move the market next. So, if you think you have a very good model and a very good price, and you are absolutely right in your assessment of what fair value is, go ahead, wait for fair value, right? I don't think I have that. So I go more with momentum, right? I go more with, it's fine, I will lose a bit here, but over the long run, I will win. So I will keep averaging, right? I'll keep buying. I have my monthly buys, I have my cash to buy on big drops. So I always have cash on the side. And so that whenever there's a dip, you don't need to worry about, should I buy, should I sell? Just buy, it's okay, right? Because the thesis or the faith is that long-term markets will go up. Of course, 30 years down the road, if that faith is wrong, then I'm fucked lah. But, I have history on my side.
Yeah. By then, we will have shut down.
Yeah.
Lose credibility. This is what these people are saying. Yeah. Okay. Fair point. Yeah.
I think with respect to deeps, right? I think we need to look at market history, and I think that always gives us a good sense, right? So the first things first is that market declines will always happen. 99% of the time, we are trading below all-time market highs. So we have to be comfortable with always below where market highs are, right? Generally, the markets tend to drop about 10% on any given year or so. Drop between 20 to 30% between 3 to 5 years, and drop 30 to 50% every I would say 1 to 2 decades, right? So if you think about that sense, you know that how often and how much are they going to kind of fall, right? So I think obviously a 20% decline is more of a larger magnitude in a very short frequency, right? So I think that will give you a sense of how big this dip is. We will never know how much, right? For all you know, it might be a dead cat bounce. You might drop a lot more tomorrow. You never know. The sense is always, I think, if the companies are strong, right? They are growing their revenues, their profits, and their free cash flows, which is really the ultimate driver of long-term market returns. Then a good price would basically mean a potentially better looking forward return. I think that's the main goal. If you think you're fairly confident that they continue to deliver that growth with a high degree of certainty, even despite the tariffs, then these are very attractive prices to add. So I think ultimately, it boils down to what it is and what you own, what companies you own, and all of that. So I think that's
So
always the
this is
best
the
way.
difference between a professional and
You just say
chapalang.
chapalang, just say
Right?
only.
It's like I can't really care. I really just care about the index, right?
Yeah,
And
yeah.
I mean I have individual companies, but I'm not really super focused on them. Whereas there he's going, yeah, what if this
Must look
affects
at
free
this
cash
business,
flow? My
yeah.
multiple goes down, then
Yeah, yeah.
how? But it's a good time because that means forward adjusted returns are better. Sorry, too much vocabulary.
That's why it's full time. It's full time. Yeah. I think there are different portfolio strategies, right? Ultimately, it boils back down to what you think it's work for you, right? So understand your base strategy when you take into account what we are saying, right? So I think that's where it is lah. Okay, so. Next question, Turtle91, also 35. He's copywriter, probably doing quite well. Copywriting did quite well over the past decade. Okay, question is, I have 25% of my assets in investments so far, which I believe it's probably in the markets, right? Stock market. But with the markets right now, how do I weatherproof, my portfolio? Probably this guy took a little bit of here and there ideas from like Dalio, and then so then it's normal, right? Especially in the internet, you have all sorts of ideas going around. So like all those full weather portfolio and all that. So guy has 25% in the stock market. Sounds like the full weather portfolio. And then now he's asking, because full weather portfolio is 25, 25, 25, 25, right? So that's the method to the madness. Of course, we also welcome Dalio on the show. Yeah. He's been spotted in Singapore quite often.
I mean,
right?
if he comes to invite me,
Yes. I'm sure there'll be an audience. I'm sure there'll be people that want to come. So we will invite Dalio to share his methods, or at least what he's become known for. I'm sure he's not the only one. But yeah, essentially that's what the Turtle91 want to ask lah. So he has a 25% in the markets and he want to full weather his portfolio. Going forward, how would you what would be your suggestions?
I think the number one rule, right, as Buffett always says, is not to lose money. And of course, the number two rule is not to forget rule number one, right? I think everyone has different goals. If you want something that is probably has a lower return profile, 5 to 7% with a higher degree of certainty, you can always find businesses that have very highly recurring revenue, very profitable already on its own. They are very clearly strong modes on their own. They can probably grow at slower rates, right? And hopefully you don't buy them too expensive, right? Maybe 10 to 20 times kind of PE kind of thing. You can get pretty good overall returns from owning this kind of companies, right? They're probably also in the later part of their life stages, maybe paying some sort of dividend of sorts. So I would say more of like this kind of companies, they're already very solid. They're earning a lot of profits, which means those profits can kind of hold the stock price, right? If you want to find something that's more growthier, obviously they probably give you higher expected returns, but they're going to be much more volatile, right? So I think if you want something that's more weatherproof, you can kind of change the mix of the companies that you want to own, because you're not able to withstand a higher, longer volatility, and change the mix of companies to be more something that, I give it the best example, right? A Coca-Cola. Tariff or not, people's going to drink Coke, right? I mean, it's not going to fundamentally change the business, right? The business is still going to be there.
And the supply chain is so optimized.
It's still going to make the same amount of stuff and everything, right? So, and it's made locally, right? The Coke mixed locally here.
Because it's very expensive to bring liquid around.
Exactly.
Very heavy to transport liquid around. So all the beverages are actually made in very regional supply chains.
Correct. So exactly right. So you buy something like that, it's probably going to be around for the next 10 years or so. People are going to still be drinking Coke. And it's going to be a very steady heavyweight. But it's not, is it going to like make 50% returns or 20%, 30% returns? Highly unlikely. So I think understanding the kind of very solid businesses that are probably have a very recurring nature in their revenues, that would probably be a much better approach to try to
so-called
do
more
that.
stable.
Correct.
You see, luckily we have Eugene.
Yeah, that's
His
right.
answers more thought through.
Hey.
Yeah. We are like just ranting around it. But there's a second part to the question. Is there an idiot-proof strategy?
No, so sorry, I'm the idiot lah. Sorry. I mean, I don't know, right? I heard the question. I was like, why are you in 25% shares and 75% cash? Like, what's the
probably not 75%
property?
cash.
Maybe property.
Some
I mean,
property,
like total net worth. Then you're
So we don't
property.
have the whole picture, but probably when all weather comes out, that means you're kind of like quartering all your kind of that's
or people just say that it's a portfolio for all seasons.
Yeah.
So I mean, in a sense, if if you know why you have the allocation, just stick to it, right? The point of an all-weather portfolio is that good times, bad times, you won't die.
Yeah, that's why you don't think about it, right?
You don't
Supposedly
just
all weather.
No,
yeah.
this is the time to execute your strategy. This is not the time to change your strategy. The time to change your strategy or the time to decide your strategy was 2 years ago, 3 years ago, right? When you start. Of course, you refine and all that, but just because the markets drop, it's not the time to change. In fact, it's the time to stick, right? So I think that's kind of my instinctive reaction. As a person who doesn't like change, just stick with your plan. What exactly to buy? Is there something idiot-proof? I think what the past week has shown is that in a time of, and COVID has shown, is a time of real crisis, right? Everything correlates to one. You talk about your various, this is not really, it's inversely correlated to that, right? You have your stocks inversely correlated to bonds, so you need both. Then after that, you got private equity, you got private credit, and they all don't mark to market, so they are not inversely, so they are not correlated. But in a real crisis, especially a crisis that lasts,
It's a free fall.
it's a free fall. Everything falls. Singapore, not volatile, also fall. Right?
Yeah.
China versus US, they are meant
Bonds
to be
also,
opposite sides,
everything
both
down.
fall
Yes,
at the same time.
Yes.
Japan developed fall, India developing fall, right? Indonesia fall. So I think the real, especially in this crisis where the US is the world power and now they are sneezing. So, there isn't a strategy short of being in cash that will allow you to say, I will have absolutely no loss. But the problem is if you move everything to cash, then you start losing inflation.
You take a decay. Yeah.
There's decay. So I would say, if you have a strategy already, stick to it and use this as a chance to test your ability to stick to your strategy, right? Because all of us plan our strategies when times are good. We think, dip, confirm buy, right? We need to double down. We need to keep buying. Statistics have shown me that I need to do it. Now is the time that you, as an investor, are put to the test to see how well you commit and how much you actually believe in your strategy.
Yeah. In fact, I would second that. I think it's very risky to reevaluate your strategy now, right?
Yeah.
Because firstly,
It's emotional.
Yeah, it's emotional. You're in flux, and the fact that you're, rethinking your strategy is firstly already showing that you have not thought through it enough, and you probably don't have enough, muscle to go through this process. And maybe it's your first one. I don't know, right? Maybe you just started, which is especially common for newer investors. I mean, when you first start, I remember the first one was like 2020. That was the first big dip. It was quite challenging.
COVID?
Yeah, COVID that period. So it was quite challenging. But over time, the second one's like, okay, you really know what you want. You have kind of
after a while, it doesn't feel like real money.
After a while, it just feels like, it's another game. It's like just another cycle, right? So if it's your first cycle, you may feel a bit like that. But I think rule of thumb is, it's very dangerous to revisit your strategy when things are happening.
And try to add to it, right? A business reports their earnings 4 times a year. Mr. Market makes the stock price every minute, right? Does Mr. Market makes the price today or tomorrow higher or lower matter? No, right? I think ultimately focus on what the business that you own in the portfolio. And if they're doing fine, keep it, right? If they're not, then of course you need to reevaluate. I think when markets come down, you should always reevaluate and find what are some of the weaker ones and flush them out. Try to focus more on quality. I think that's always a much better approach.
And I think it brings back to the part of like right-sizing your risk, right? Because good times, everything moves, right? At bad times, which I think the backdrop will continue, then quality will, supposedly the theory is quality will rise above, right? So some of your bets, right, maybe you can adjust it, right? So that is for you to decide. But I think, as much as we make a joke of some of these things, there's some wisdom in Tinfa, okay? Yes. So okay. So last question. Actually, there are a few questions, but they all link back to the same thing, right? So whether is it like Ninja Boy, which is a 47-year-old IT professional, or like Bananas, right, which is 36, risk and governance professional, they all lead back to like, so what are you buying? Broadly speaking, right, what to buy, right? So once again, I repeat, this is not financial advice, Tinfa, right? So Eugene, I put a hook in front, right? So yeah, what are you looking at? What interests you?
I think the best way to try to differentiate this is just like in COVID, right? When COVID happened, suddenly the stock market, like Netflix for example, fell 30%, and everyone started watching more Netflix. So actually, you should buy Netflix, right? So I think we have to come back to this, right? Tariffs came down. So for example, like, in the fund that I manage, obviously, this is not, we own all of the stocks I mentioned. We own a lot of services, companies that sell a lot of services naturally by their nature, because they tend to be very highly recurring in nature. Now you have a broad goods tariff sell-off, and a lot of these companies that are selling SaaS companies, for example, down 30%. And this customer, for example, you have an AWS, someone's on AWS, they sign 3 to 5 year contracts. The customer is not going anywhere anytime soon, right? They're still going to be around. So I think you have to try to find companies that are owning some of this, and I think where we see it's really very attractive. So I mean, we look at very secular themes. So like, for example, we look at e-commerce, payments, digital payments, SaaS, for example, and digital payments. So I think just look at it. So like, you look at e-commerce, for example, I think Amazon, we have a lot of numbers like Amazon and Mercado Libre, which is an e-commerce platform in Latin America. These are some of the ones that we have in the portfolio. I think there's still a very long-term tailwind. If you look at US e-commerce as part of retail sales, it's probably around closer to the high teens of percentage of retail sales, which means, and we only took like 20 years to get here. So for us, I think the number is probably of where they're going to hit. And just for mine, right, China is probably like 40-50%. So like, for the US to get the 40-50% is probably another 10-20 years plus, and easily, right? So we're still in the early part of the S-curve of a very long dated tailwind, right? Same thing for Latin America as well, right? Then if you look at, say, for example, digital payments, the world is moving to digital payments. Like in Latin America, we have a company called Nubank. They're rapidly doing it very quickly. Everything is digital. There's no branches, and it's very attractive. Some of the other ones like SaaS, obviously cybersecurity, right? Like CrowdStrike, for example. The customers sign long-term contracts, and then if everything is going digital, you need cybersecurity. So I think so what we try to look for is mission-critical companies that are very highly recurring in nature. If anything like a trade war, people are still going to need it. They're not going to actively move it from their way. So you try to find some companies that are very quality in a sense, and you try to find these. So a lot of the companies actually, I would say almost every single company in the fund that we owned have been down massively. And I think you just try to go back to the business itself, and when you see the strength of these businesses.
Okay, fair. So SaaS, a lot of services, payments, banking, some of this digital stuff. Okay, fair. No wonder you can come here so comfortable. No concern about trade war.
So that's quite interesting, right? Because the whole trade war so far has really just excluded services.
Yeah.
Right? And I guess the risk is the EU decides that they do want to fight back, and then they start fighting back through imposing services.
Ursula von der Leyen has come out and said that they will put up some, tariffs.
But then, the EU has been against services for like the longest time. Anyway.
Because they don't have, right? So, hey, sorry.
This is going to be a great powers competition. At the end of the day, there's going to be 2 countries with their own spheres of influence, right? And then there's all these smaller ones, Japan, EU, India, Southeast Asia, hopefully coming up and
please come together as a group.
Yeah, please come together, right?
Bigger negotiating power.
And then that means that from China's perspective, you have to do something. You cannot just rely on US capital markets, right? You cannot just rely on Hong Kong. You cannot rely always on foreign capital, right? And we have kind of seen them kind of retreat into their own capital spaces. So actually what I bought a lot of was China. I think the reality is that if there are going to be 2 powers, and I quite like the Chinese power. I think they are very, very good at the things that they choose to do. So, I need to be allocated to that. And I think, and this is partly a reflection of historically, the US went up so much, the Chinese went down so much, that I've never really rebalanced. So it was very, very,
good time.
Yeah, so now is a good time to, since I have capital, buy a bit more, try to bring the allocation up a bit, because if the world is going to be split, my goal is not to make good returns every year, right? My goal is to survive so I can retire and do things that I want to do. So I just need to survive. And if I want to survive, I should be Singaporean. I have interest in both sides.
Mm-hmm. Okay, fair. Awesome. Okay, good. Thank you for your time. Thanks for your questions. If you have more questions, put in the comment section. We may do another emergency if the emergency blows up, But if not, this is not financial advice.
Just continue.
Yeah. Enough. So if not, this is not financial advice. We will see you another time. If our audience would like to connect with you, but your fund is accredited investors only, right? Yeah, but if they would like to connect with you, where's a good place for them to connect?
You can find me on Twitter, Eugene.
Oh my
Eugene
God, Twitter
_VCAP.
Or X. Yeah.
Correct.
Oh my God.
And on LinkedIn as well. You can find me Eugene Ng. I run Vision Capital Fund. You can look for my website.
Okay. Sorry, the handle again.
Eugene EUGENE ng_VCAP.
Awesome. Thank you. So we hope you enjoyed today's episode and we'll see you next week. Meanwhile, take care. We hope you find good buying opportunities for yourself. But yes, once again, Tinfa, this is not financial advice. Bye-bye.